You can win 7 out of every 10 trades and still bleed your account to zero. That's not bad luck, and it's not the market being rigged against you. It's a trap hiding inside your win rate, and expected value drags it into the light. Quick note before we start. This is educational commentary, not personalized financial advice. I'm going to show you the mechanism, and you decide what to do with it. Here's the belief almost every retail trader carries into the screen. If I win more often than I lose, I make money. It feels obvious. It feels like common sense, and it is completely wrong. Win rate tells you how often you're right. It tells you nothing about how much you make when you're right versus how much you lose when you're wrong. Those are two different questions, and only one of them pays your bills. Let's make it concrete with the simplest possible case. You take 100 trades. You win 70 of them and lose 30. Sounds like a winner, but look at the payoffs. On each winning trade, you make $10. On each losing trade, you lose $30. You set a tight target and a wide stop, which is exactly what most people do without noticing. Now do the arithmetic that actually matters. 70 wins times $10 is $700. 30 losses times $30 is $900. You were right 70% of the time and you finished the 100 trades down $200. Your win rate was excellent. Your account still shrank. That gap is the whole video. The formula behind that result is expected value, and I want you to feel it, not memorize it. Expected value is your win rate times your average win, minus your loss rate times your average loss. It's the average dollar outcome of one trade, repeated forever. In our example, that's 0.7 times 10 minus 0.3 times 30. That equals minus $2 per trade. Every single time you click buy, you are volunteering to lose $2 on average. Here's the aha sentence I want you to carry to the screen tomorrow. You are not paid by how often you're right. You are paid by expected value. A high win rate is just one ingredient, and it's the ingredient traders overweight because it feels good. Being right is emotionally satisfying. Expected value is what compounds your capital. The market does not hand out prizes for feeling smart. Now, why does the 70% strategy attract you in the first place? Because payoff asymmetry and win rate trade against each other. If you want to be right more often, the easiest way is to take profit early and give losers room. Tight target, loose stop. That mechanically raises your win rate and quietly poisons your payoff ratio. You feel like a genius on a hot streak, right up until one wide stop loser erases 6 winners. Flip the same math and you'll see why the pros tolerate being wrong. Imagine a strategy that wins only 40% of the time, but each winner makes $30 and each loser costs 10. Expected value is 0.4 times 30 minus 0.6 times 10. That's 12 minus 6, a positive $6 per trade. You are wrong more than half the time and you make money on every 100 trades. That's the trend follower's whole life. This is where a real edge lies. 2 numbers only, how often you win and the ratio of your average win to your average loss. Multiply them the right way and you get a break-even map. At a 1-to-1 payoff, you need to win more than 50%. At a 2-to-1 payoff, you only need about 34%. At a 1-to-3 payoff, the tight target trap, you need to win 75% just to break even. Our 70% trader was underwater before the first click. Options traders, this is your daily reality whether you name it or not. Selling premium feels amazing because you win most months. A far out-of-the-money put might expire worthless 90% of the time. 90% win rate. But that 10th outcome, the gap down, can be 10 or 20 times the premium you collected. You're not printing money. You're being paid a small, steady fee to warehouse a rare, giant loss. If the fee is too small for the tail, your expected value is negative even at 90%. There's a second-order effect most people miss, and it's brutal. Expected value assumes you survive to play the average. If your losers are large relative to your account, a normal losing streak can cut your capital so deep that the math never gets to save you. Lose 50%, you need 100% gain just to get back. That's why position sizing isn't separate from edge. A positive expectancy with reckless size still ends at 0. So what does a disciplined trader actually do with this? First, they measure expectancy, not win rate. They track average win, average loss, and win percentage as 3 numbers, and they combine them. Second, they refuse the tight target, loose stop dopamine trade unless the win rate genuinely justifies the payoff. Third, they size so that a realistic string of losers can't take them out of the game. Win rate is a story you tell yourself. Expectancy is the receipt. Here's where this transfers beyond trading. Any decision with repeated bets and uneven payoffs runs on the same engine: startups, insurance, poker, even hiring. A choice that's usually right but occasionally catastrophic can be a losing choice. A choice that's usually wrong but pays huge when it hits can be a winner. Ask the same two questions everywhere. How often and how much each way? Then multiply. So next time someone brags about a 70 or 80% win rate, don't be impressed yet. Ask them the size of their average loser. That one question tells you whether they have an edge or just a comfortable way of going broke. If this made the math feel obvious, subscribe. We break down the machinery behind trading decisions calmly with the numbers in front of you. Signal, not hype.